the concept well in detail. All right.
Ma'am, I have one doubt.
All right. Tell me.
Ma'am, like in the reinsurance ceded and the reinsurance accept, can you explain the commission part, like who paid the commission?
All right. We'll cover that today. Okay. I'll start with the presentation first, and then I'll come back to your question. Mitali, you were there in the previous session.
Yes, ma'am.
All right. I'll ask everyone to solve the first question for me. While they're at it, I'll discuss your question. The first one is a very simple one. What are the main lines of business in general insurance? We had discussed this in the last session. For those of you who are new, we had discussed that the major two lines of business are motor and health. And you just don't have to accept this because I am telling you. You can go and check this in the NL4 of the public disclosures of any GI company. I'll quickly tell you how to do that. Let's say we're doing ICICI Lombard. So I'll type in ICICI Lombard public disclosures. Click on the first link. Over here, financial disclosures. And then NL4 is for premium. You can see the first column here is for the premium amount at the LOB level. So when you go through these figures, you'll realize the biggest figures are for health and motor for most companies. But again, when you're applying for a company, you'll go through the NL4 and you'll see what the main lines of business is for general insurance. So all those who are attending the class today for the first time can quickly open the public disclosure for, let's say, HDFC and tell me what is the biggest line of business for them. And for Mitali, let's just discuss your doubt. Okay, Mitali. Let's say I am writing a business of 100 rupees premium, out of which I am giving the agent 10 rupees. Why have I given the agent 10 rupees?
To sell the policies.
Sell the policy, right? Similarly, now let's say a company B has written 200 rupees and it has given its agent 15 rupees. So it has 185 rupees with it to cover the risk. Yes or no?
Yes, ma'am.
All right. Now, out of this 185, basically, when a company seeds, they'll say, okay, I'm giving you 10% of my business. So basically, they're giving me 20 rupees, right? Let's say I am the reinsurer here. I am reinsuring 10% of company B's portfolio. So they're giving me 20 rupees. Yes or
Yes,
no?
ma'am.
But again, it has incurred an expense of 15 rupees. So I should reimburse a part of it to them. Yes or no?
Ma'am, didn't get this. Like,
All
uh,
right. Okay, again. Company B has written 200 rupees of premium. It is giving me 10% of it.
ma'am means company A is accepting the
I'm the
reinsurance.
reinsurer. Okay. And this is the
Yes.
insurance company. Company B is writing 200 rupees of premium. It is giving its 10% of portfolio to me. I am the company A. I am the reinsurer. So it's giving away 20 rupees of its premium to me. Does that make sense?
Yes.
Now, company B had incurred an expense of 15 rupees to source this business, which is a
Yes.
part of 200. It's actually 185 for the risk and 15 for the commission. But it is giving me 20 out of 200. So it becomes my responsibility to bear a little bit of commission also, to bear
Yes.
the expense. This I will reimburse when the claims arise. For this part, risk part is when claim will occur. But I'll have to take at least or around 10% of this expense also. I have to bear that because we are basically 90-10 partners on this risk, on this
Yes.
business. So I will give away 10%, roughly 10%, depends on what negotiation company A and B have, but somewhere around 10%, I'll give it 15, let's say it's 10 and 190. So roughly 10%, I will give it back. So I'll only take 18 rupees, sorry, 19 rupees, my bad, 18, 10% to cover this risk. So this 2 rupees commission will flow from the reinsurer to the insurance company.
Yes, ma'am.
And this is going to be 5%. Understood? Sure? Or do you want me to repeat it one more time?
Ma'am, what is this 5%?
Basically, 200, 5% was commission, 95%. So 10 and 190 is the split,
Okay, okay.
giving away 10% of the business. So it's giving away 20 rupees
Right.
to me. So 1 and 19.
Yes, ma'am.
And for the others, did you go through the NL4 of Bajaj as I had asked? All right, the way I do my sessions is if you've understood, you give me a thumbs up, you tell me that you've understood so that we can move on to the next topic. Or you put it in the chat that we've understood how to go to NL4, that is the premium disclosure, because that we had discussed in length in the last session. It won't be fair to the ones who are repeating to do the entire thing one more time. Can I move to the next topic? All right. Okay, the next question is, can you explain the difference between frequency and severity in insurance? So the sentence would be frequency is measure of how often a claim occurs and severity measures the average cost of claim. Simply put, what is frequency? Let's say I have insured 100 individuals. Basically, I've given health insurance policy to 100 people. I know the frequency is 10%. Now, what does that mean? It means that there is a 10% chance that a person claims. So, 10% chance that a person claims. So, if I insure 100 people, I am expecting 10 claims from them. So, that's the frequency. So, measures how often claims occur. So, let's say 10% for a health insurance policy. What is severity? Let's say I received 5
Ma'am,
claims last year. Yes,
ma'am, it means 10 policies will have a claim.
yes,
Oh,
because I'm insuring 100 people. So for each person, there's a 10% chance that that person claims. But if there are 100, how many claims can I expect? 10 claims?
10.
All right. Similarly, let's say I received over a different portfolio, I received 5 claims. 400, 300. This is the claim amount. 400, 300, 300, 200, 500. Now, what's the average? 4 plus 6, 10, 17 by 5. 340 rupees is the average. Now, given my past claim experience, I know on an average, when there's a claim, the average claim amount is for 340. So that becomes my severity. Now, how do I use that? Let's say there's this one person that comes to me. I know there's a 10% chance that he claims. Again, this 10% is derived from our past experience, given his age, sum insured, health condition, whatever. I've used my past data to see that, okay, this typical person has a 10% chance of claiming. And when he claims, the claim amount is going to be 340. So my risk premium is 34. This is the frequency severity method of calculating the risk premium. Understood? I'll repeat this one more time. When a person, for this typical person, I know based on my past data, there's a 10% chance that he's going to claim. And when he claims, he's going to ask for 340 rupees. So frequency times severity, 34, becomes my risk premium. I can't go around and ask every person that I insure rupees 340. Then otherwise, what is the point of insurance? If he gives me 340 and when he claims, I'll have to give him 340. So what about the times that for which he won't claim? I can't ask him 340. That is why I put in the angle of frequency. There's a 10% chance that he claims. And when he claims, the claim is going to be for 340. So according to me, the risk premium is 34 rupees. Understood?
Ma'am, can you explain the 10% one?
All right. Again, 10% is the probability that he's going to claim. How do I get to that? Let's say in the past, I had insured, sorry. In the past, I had insured 500 policies and I received 100 claims. So what is my frequency for this portfolio?
20.
And how did you get to that?
100 upon 500 into.
So you've understood what 20% means? There's a 20% chance that there's a claim from a policy. So that is frequency. How often claims occur? There's a 20% chance that if I'm selling a policy, there's going to be a claim. So basically, for every 5 policy, I know there's going to be 1 claim. So insurance is nothing but pooling of risk. Let's say the claim on an average is for 100. All right, I need 100 rupees for that 1 claim. And now out of 5, I know from 5 people in totality, I'm expecting a claim of rupees 100. So what I'll do is I'll collect 20 rupees from each person. So that 5, when I'm insuring 5 people, 20 times 5, 100, I have that 100 ready because I know out of every 5, 1 person will claim for 100. Now from that group of 5 people, I've collected 100 rupees, 20 each, a total of 100 to meet that 1 claim. So that is why we take into account frequency. Understood?
Yes, ma'am.
What about the others? All right, we'll move to the next question then. One bit. What is the importance of frequency and severity in insurance? It helps in risk assessment. We know 34 is the risk that this person is bringing. Next, it is helpful in premium setting. This part we've discussed. Now, what is reinsurance and why is it important for general insurance? This again we had covered in the last session, but transfer of risk from one insurer to another. What is reinsurance in simple term? I'm an insurer. I've collected premium for 1 lakh cars. Now I'm afraid that this portfolio is too much. So I give away a part of this to another company, to another insurance company that is a reinsurer. And this transaction between me and this other company is a reinsurance. So that is reinsurance, transfer of risk from one insurer to another. And what is its importance? It reduces exposure to large claims. So basically, there are different kinds of reinsurance. For simplicity, right now I had discussed a proportional structure where this person had ceded 10% of the business. Company B had ceded 10% of the business. So I became a partner of 10% of premium and 10% of claims. There are other reinsurance structures also where the arrangement is such that, okay, I'll insure all the policies that you have written. If the claim amount is, let's say, higher than 1 lakh, up to 1,50,000, I'll bear that bit from 1 lakh to 1,50,000. So those type of structures help reduce exposure to large claims. And then again, it stabilizes financial performance. How? For the structure that I just discussed, okay, I'll cover claims between 1 lakh to 1,50,000. It reduces volatility in claims. It reduces our exposure to large claims. So let's say if a book gets hit with a claim of 1,40,000, 1,50,000, the reinsurer is going to bear the 40,000, 50,000 amount. My PNL will look better and my financial performance will look better. So that is the importance of reinsurance. We had discussed reinsurance in the previous class. That is why I'm not giving it much time today. Understood?
Yes, ma'am.
I would want a little bit of participation from others as well. All right, I'll move to the next question. The concept of combined ratio and its significance. Again, loss ratio plus expense ratio plus commission ratio. What is loss ratio? Again, I've written a premium of 100 rupees. This is the premium amount. Out of this, I know some will be used to service claims. 10 rupees I had paid commission and 20 rupees are the other management expenses that I have incurred. So what becomes my loss ratio? Loss ratio is 60%, 60 over 100. What is my commission ratio? It is 10 over 100, 10%. And what is the expense ratio? 20%. These three combined make up the combined ratio, that is 90%. So the formula for combined ratio is loss plus expense plus commission. I don't want you to memorize this, but just think of it in this way. Whenever I collect a premium as an insurer, what this is my inflow. What are the possible outflows? I will have to pay some for claims, some at inception for commission, and other management expenses to maintain and service the policies. So these three combined make up the combined ratio. Now, what is its significance? If it's below 100%, it's underwriting profits. See, in this scenario, for the 100 rupees that we had collected, we are only paying out 90 rupees. So basically, 10% becomes my profit. So this policy has made a underwriting profit because the combined ratio is less than 100. Over here, let's say if the claims were 80 for 100 rupees premium, then my net loss ratio would have been 80%, 10 and 20, 110%. So that would mean for every 100 rupees that I'm writing, my outflow is 110. That is a combined ratio of 110%, and we are making a loss. Okay. Understood? Much better. Okay. This is one of the most frequently asked questions in a GI company. What are loss triangles and how are they used? Tables of claims data by development period. All right. Do all of you know the concept of IBNR, incurred but not reported, or do you want me to repeat? Repeat, please. All right. Stands for incurred but not reported. I am closing my books on December 31st as an insurer. I'm the insurer. There was a car accident on December 28th that I, as the insurer, don't know because the claimant has not yet informed the company. The claimant has not yet informed about this car accident which occurred on December 28th to the insurer by December 31. So this claim is incurred but not reported. So what the insurance company does is it makes an incurred but not reported reserve in its account to take care of this claim amount that will come in the future. Using the past experience, the company knows that there are many claims that have incurred, but they are not yet reported to us. So we cannot just close our account ignoring that amount. Using technical, statistical, actuarial methods, we will make a reserve. This is one of the biggest roles of an actuary in an insurance company, to calculate the IBNR reserve amount. So, to take into account, now this is just one example, there will be thousands and thousands of cases of such accidents, incidents that are not reported to the company. So the company will build reserves for all such claims that it is anticipating from events that have occurred but not yet reported. So that is the concept of IBNR reserve. Now, what are loss triangles and how are they used? So there's this
Ma'am, they
method.
don't know about the accident, so how they will
All right, that is what we are going to discuss. Again, actuaries use a lot of data, past experience to calculate what the reserve is going to be. There's one such method called chain ladder method. We are going to discuss that, and that will give you an idea of that. Yes, we can indeed calculate what the IBNR amount is going to be. Let's say uh, we are at the end of financial year 2020. First development, second development, third development. Now, our company started operations in 2018. For all the accidents that occurred in 2018 and we were informed about them, those claims were for 100 rupees. Next year, in 2019, we'll come to know about claims that occurred in 2019 and 2018, right? So for 2019, this figure was 120, and we got to know about another 20 rupees claims that was for 2018, because over time these claims will get reported. In the past, we've seen for 2018, the amount reported was 100, another 20 rupees got reported, and this amount got up to 120. Similarly, when we came in financial year 2020, this amount was 110. For this, let's say 25 rupees and 5, 125. You've understood the triangle, or do you want me to repeat?
ma'am, that 125 amount, like for the
Right.
year 2018, it
Mm.
means
Which amount? 125?
Yes, ma'am.
All right.
It
When I'm closing the account in 2018, I was just aware about this 100 rupees. But another year passed. So 120. But we came to know about 20 more claims for year 2018. So this figure of 100 came up to 120. Similarly, another year of experience. In 2020, we'll come to know about claims for 2020, 2019, and 2018. So out of all the claims that were reported in 2020, 110 was for accidents of year 2020. So that is why I'm entering 110 year. We came to know about another 25 claims for the year 2019. So I added 25 to 120, 145 year. Similarly, we came to know about 5 more rupees of claims for the year 2018. So 120 has now increased to 125. Understood?
Yes, ma'am.
All right. So now this is what a loss triangle is. First development year, second development, and third development. So basically, by third, 100 became 125. By second, 120 became 145. But for 2020, all that we know is 110. So now, tables of claim data by development period. Does this definition now make sense? It is claims data. It's in a table format given by development period. This is your development period. Now, identify trends. How can we use this to identify trends? 100 becomes 120, 120 becomes 125, 120 becomes 145, 110. So it's giving me a trend. This will be used to calculate ultimate claims. We are going to do this in the next question, and it is essential for reserving and pricing. Now, reserving bit we'll cover in the next question, but for pricing, just think of it in this way. Right now, when we were discussing frequency and severity, I said that, okay, according to my experience, for 500 policies that I had written, there were only 100 claims. So the frequency is 20%. But what can happen is we still don't know if this figure is 100 or it's going to become 120 or 110, or is it going to stay at 100, because we want to add in the incurred but not reported. We want to increase this for the possibility that the number of claims can increase. For these 500 policies only, we will have to use loss development triangles. So that is on the reserving pricing bit. Reserving we are going to do in the next question. Okay, now what is chain ladder reserving? A method for projecting future claims based on past development data. I'll just quickly write down the triangle. Okay, now what is chain ladder method? If I add these two figures and if I add these two figures, 140, bad idea. 140 plus 125 and 125 plus 110. Okay, before I do that, can we see what is the multiplier here? 120 becomes 140. So there's a multiplier of 1.167. And if I'm using the 2019 data, the multiplier is 125 divided by 110. So that's 1.137. Does this make sense? I've calculated multipliers based on my past data. Okay, 120 becomes 140. from development period 1 to 2. Similarly, 110 becomes 125. That is a multiplier of 1137 from development period 1 and 2. Obviously, these two are not going to be the same. Year on year fluctuations are normal. But now what multiplier I do use for year? What I'll do is I'll use the experience of both years combined. In the numerator, I've taken 140 plus 125. For the denominator, I've taken both 120 and 110. So combined, I'll calculate 265 divided by 235. So that's 1.13. So now I can 1276, whatever the actual figure is. 260, my bad, 260 over 235. So the actual figure is 1.10. So my past experience tells me
Ma'am,
I use
wouldn't it be 120?
140 plus 125, right? 120 plus 110. 140 plus 125 over 230. 1.15. So now my past experience is telling me when I go from period 1 to period 2, the multiplier is going to be of 1.15. So when I multiply it by 130, I get 149.78. I'm just writing down 150 here. So I know that 20 more claims are going to get reported between during period 2, development period 2 for accident year 20. Everyone has understood this? All right. So using my past data, my past experience of what happens between development period and development period 1 and development period 2, I've used that information to gauge, okay, my 130 will likely become 150 by the end of year 2. That means I am expecting another 20 rupees of claims during development period 2. So basically during 2021 for accidents that occurred in 2020. Now this is what IBNR figure is, the 20 rupees amount. Again, we'll have to do the same exercise for development period 2 to development period 3. But this time, we only have these two data points. So we'll simply calculate the IBNR based on these two data points. In reality, companies have big triangles. For my company, at least, we have triangles that is from year 2002, 2003 and earlier to the latest figure. So we have good 20-25 years of development experience that we use when we calculate the chain ladder method. And again, one of you had asked, what if the company does not has prior experience? Then we cannot use the chain ladder method, one. Or if the actuary has some experience from other company or he knows what the industry multipliers is, he can use that. But if the company is new and it does not have its own triangle, we cannot project IBNR claims using our triangles because we don't have any. There are other methods in that case. Similarly, 145 by 150, 145 by 140, a multiplier of 1.035. So I'll multiply 125 by 1.035. I know 125 will roughly become 120. 125 will become 129. So I'm expecting 4 more claims. Similarly, this 150 will also increase during the development period 3. So the multiplier 145 by 140 was 1.03. If I multiply that by 150, I know it's going to become 155. So 5 more claims. Over here, we got 20 more claims, right? So the IBNR figure today is all those claims for accidents that have occurred but are still not reported. So my estimate for the IBNR is 29 rupees by, I know 125 will become 29. So 4 is stemming from accidents that have occurred on 2019. I know 20 claims for the accident year 2020 during the development period 2. So that 20. And then it will further increase to 155 because I know I'll get 5 more claims for accidents that have occurred during development period 3. So all of these together is 29. Now over here, I'm assumed that by the end of 3 years, I get to know about all the claims. If there's further development, then we can just increase and the triangle gets bigger. This is why it's called a triangle. All right. What is chain ladder reserving? A method of projecting future claims based on past development factors. What is the key assumption? Past trends will continue in the future because that is what we've relied upon. According to me, in the past, the increase factor is roughly the multiplier is 1.15, the increase factor is just 0.15. So I'm assuming that it will hold true for the future as well. So past trends will continue in the future is my assumption when I'm doing reserving using the chain ladder method. Understood?
मैम
Yes.
मैम जैसे आपने कहा कि 20-25 ईयर्स का लॉस ट्रायंगल होता है कंपनी के पास
हम्म।
और फ्यूचर करते हैं हम क्लेम्स का प्रोजेक्ट,
हम्म।
लेकिन फिर वो इन्फ्लेशन का भी तो रहता होगा, वो
हाँ,
कैसे
ये
एडजस्ट
बहुत
होता है?
मैंने बेसिक स्ट्रक्चर बताया है, इसमें हमने कुछ इन्फ्लेशन को टेक इनटू अकाउंट नहीं किया, अज्यूमिंग मतलब आई एम ग्लैड यू नो अबाउट इट, बट ये क्योंकि हमने स्ट्रक्चर किया था फॉर फ्रेशर्स जिनको फर्स्ट जॉब चाहिए, तो हाँ इन्फ्लेशन एडजस्टेड चेन लैडर मेथड होता है, फिर ट्राइंगल्स में बीएफ मेथड भी होता है, तो अभी हम उसमें नहीं जा रहे बिकॉज many of the people who are attending this session don't even know what a triangle is, तो अभी इन्फ्लेशन वाला एंगल नहीं डाल रहे हैं, बट यू आर राइट कि इन्फ्लेशन होता है। पास्ट में 120 150 बना है, लेकिन अब अगर 120 होगा तो 150 नहीं, थोड़ा ज्यादा ही बनेगा क्योंकि क्लेम सब उससे ज्यादा मतलब 30 में वो सेटल नहीं होंगे, थोड़ा इन्फ्लेशन है 10% का, तो वो 30 की जगह 33 में होंगे अब सेटल, तो वैसे टेक इनटू अकाउंट करते हैं, बट फ्रेशर्स के लिए हाँ 120 150 बनता है, तो इफ दे नो दिस मच दे आर गुड इन द इंटरव्यू।
ओके मैम, थैंक यू।
ओके, इस पे वैसे एक क्वेश्चन था मेरा, अभी कर लेते हैं, शायद डाला नहीं है, बट हाँ यू आर राइट इन सेइंग कि इन्फ्लेशन भी एक फैक्टर होता है। बाकी सबको चेन लैडर समझ में आया? ओके, ये हेमंत योर क्वेश्चन, हाउ डू वी मेक द अजम्पशन दैट द क्लेम्स हैव डेवलप्ड फुली? तो बेसिकली जैसे मैंने बोला कंपनीज के पास बहुत बड़ा बड़ा ट्रायंगल रहता है, हमारे पास क्लेम्स डंप भी होता है। मेरे को पता है आज मेरा हेल्थ पोर्टफोलियो है, उसमें मैक्सिमम 6 महीने में सारे क्लेम खत्म हो जाते हैं, 6 महीने में मुझे पता चल जाते हैं, उसके बाद बहुत थोड़ा डेवलपमेंट होता है, तो देयर आर टू वेज दैट आई कैन अंडरस्टैंड। लेट्स से मैंने इस साल का पूरा क्लेम्स डंप लिया, फाइनेंशियल ईयर 23-24 जो कंप्लीट है, उसमें कोई भी ऐसा क्लेम नहीं है जो लेट्स से कट ऑफ डेट ला लिया 1 अगस्त 22 के पहले का नहीं है, तो मुझे पता है कि 1.5 साल के अंदर 1.25 ईयर्स के अंदर सब क्लेम्स पता चल जाते हैं, तो मेरा वो कट ऑफ होता है विदाउट लुकिंग एट द ट्रायंगल। अभी तक मैंने ट्रायंगल नहीं देखा, मुझे पता है कि इस साल जो मुझे पता चला इससे पहले का कुछ पता ही नहीं चला है, इसका मतलब मुझे सारे पता है। सेकेंड, जब एक कंपनी के पास 20-25 ईयर्स का ट्रायंगल होता है तब लेट्स से यहाँ पे 20 साल है, 2002 3 4 5 6 7, फिर क्या होता है कई डेवलपमेंट पीरियड के बाद लेट्स से अगर ये 100 का फिगर है ना, ये 100 पे ही रह जाता है, ये डेवलप ही नहीं होता है क्योंकि मेरे बुक्स में कुछ और आया ही नहीं, तो मुझे वो कट ऑफ समझ में आ जाते हैं। तो अगर मैं इस डेटा पॉइंट को यूज भी करूंगी, मतलब लेट्स से डेवलपमेंट पीरियड 7 एंड डेवलपमेंट पीरियड 8 इन हेल्थ, मुझे पता है जो फिगर यहाँ है वही फिगर यहाँ है, जो यहाँ है वही यहाँ है, तो मैं सम ऑफ दिस डिवाइडेड बाय सम ऑफ दिस करूंगी तो मल्टीप्लायर 1 ही आएगा, तो इवन इफ आई यूज इट मुझे पता है डेवलपमेंट नहीं होता है, आईबीएनआर नहीं बनेगा।
मैम आप
यस मिताली?
मैम आप कुछ लिख रहे थे, वो शो नहीं कर रहा था स्क्रीन पे।
अभी दिख रहा है मेरा स्क्रीन?
यस,
तो मैंने यही लिखा था जो दिख रहा है, ये दिखा है 100 डैश डैश।
अभी अपडेट हुआ।
ओके, सो बेसिकली व्हाट आई वाज सेइंग इज बहुत सारे एक्सीडेंट ईयर्स है, लेट्स से हेल्थ पोर्टफोलियो है जो 2 साल के अंदर खत्म हो जाता है, तो फिर इसका 7th और 8th डेवलपमेंट पीरियड में क्या होगा, अगर 100 रुपया आया है तो यहाँ पे भी 100 ही होगा क्योंकि मुझे पता है कि नहीं आता, और अगर लेट्स से इक्का दुक्का कुछ आता भी होगा, यहाँ का 200 रुपया यहाँ का 200 अगर 202 बन भी जाता है, लेकिन इतना कम होगा तो ये फैक्टर ऑब्वियसली 1 नहीं रहेगा, ये 1 पॉइंट ऐसा कुछ बन जाएगा। तो मैं जब यहाँ लेटेस्ट फिगर जो भी होगी जिसपे भी ये फैक्टर लगाने वाली हूँ वो थोड़ी थोड़ी मार्जिनली बढ़ जाएगी। तो ऐसा नहीं होगा कि हम इग्नोर करेंगे, अगर कुछ भी इंक्रीज आया होगा वो मेरे फैक्टर में रिफ्लेक्ट होगा, भले ही कितना छोटा हो। और जब मैं उसको मल्टीप्लाई करूंगी मेरे अभी तक के एक्सपीरियंस से, तो वो बढ़ाएगा मेरे आईबीएनआर रिजर्व को, मार्जिनली ही सही, लेकिन जितना बढ़ना चाहिए उतना बढ़ेगा। हेमंत, डज दैट आंसर योर क्वेश्चन?
Yes, ma'am.
Ma'am, why aren't we taking the average of the rates like that 1.167 and why are we
बिकॉज वी आर टेकिंग इन टू अकाउंट द एक्सपीरियंस। अच्छा लेट्स से मैंने ना ये बिजनेस अभी लिखना चालू ही किया था, सॉरी, ठीक है, अभी मैंने फर्स्ट ईयर लिखा था ये बिजनेस, बहुत साल हो गए, लेकिन जब मैंने फर्स्ट ईयर लिखा था तब मैंने बहुत कम पॉलिसीज बेची थी, तो 10 की सिर्फ 12 हुई। नेक्स्ट ईयर मैंने बहुत अच्छा बिजनेस लिखा, मैंने वो 100 लिखा और 130 बन गया। तो यहाँ पे तो मल्टीप्लायर 1.2 का है, यहाँ मल्टीप्लायर 1.3 का है। अगर मैं सिर्फ एवरेज लूंगी तो मेरा 1.25 बन जाएगा, राइट?
yes.
बट अगर मैं एक्चुअल में अपना एक्सपीरियंस देखूंगी तो 110 142 बना है, राइट? 110 के क्लेम्स 142 बने हैं, 130 + 12 ओवर 110। तो एक्चुअल मल्टीप्लायर जो रहा है वो 1.29 का बना है। टू टेक इनटू अकाउंट बेसिकली वेटेड एवरेज किया है हमने, सिर्फ एवरेज नहीं लेते। जब मैं ये करती हूँ कि 130 + 12 divided by 110, तो आई एम नॉट जस्ट डूइंग अ सिंपल एवरेज, आई एम टेकिंग द वेट्स इनटू अकाउंट कि यहाँ का बिजनेस ज्यादा है तो मुझे यहाँ की बात को ज्यादा वेटेज देनी है क्योंकि यहाँ का एक्सपीरियंस है। ये तो बहुत कम एक्सपीरियंस है, अगर मैं इसके बेसिस पे 1.25 कर लूंगी तो गड़बड़ हो जाएगी ना। एक्चुअल में 1.3 है जहां वॉल्यूम है। लेट्स से वो जो फ्रीक्वेंसी वाला एग्जाम्पल था अपना, फ्रीक्वेंसी लेते टाइम मैंने क्या बोला कि 500 पॉलिसीज लिखी थी, उसमें 100 क्लेम्स आ गए, तो रफली मैंने एस्टिमेट कर ली 20% है। अब लेट से मैंने बेची ही 10 पॉलिसी थी, उसमें 3 क्लेम आ गए, तो बिकॉज यू नीड डेटा टू कम टू अ कंक्लूजन, तो हम उसको ज्यादा वेट देते हैं जहाँ पे एक्सपीरियंस है। तो ये जो फर्स्ट वाला ईयर था इसमें एक्सपीरियंस कम है, 10 और 12, इसका 1.2 को हम कम वेटेज देना चाहते हैं, इस एक्सपीरियंस को ज्यादा देना चाहते हैं, इसीलिए हम 142 बाय जब 110 कर रहे हैं तो आ रहा है 1.29, विच इज सॉरी 142 बाय 110 1.29, विच इज क्लोजर टू दिस फिगर। वाई? बिकॉज यहाँ पे एक्सपीरियंस ज्यादा है। ऐसा नहीं कि हमने इसको इग्नोर कर दिया, ये 1.3 से 1.29 इसीलिए बना है क्योंकि ये यहाँ पे 1.2 का मल्टीप्लायर है, तो हमने उसको इग्नोर भी नहीं किया, बट हमने उसको सिर्फ उतना वेटेज दिया जितना उसमें डेटा है। गॉट इट?
Okay, ma'am. Yeah, thank you.
All right. Okay, next question. How do you calculate the ultimate losses using development factor? टेक्निकल क्वेश्चन है, सिंपल हिंदी में बोलती हूँ। ये वाले चेन लैडर मेथड से मेरे को हर ईयर का अल्टीमेट पता चला, 125 129 155 145 129 और लेट्स से 120 था। मुझे पता है कि हर एक्सीडेंट ईयर के अल्टीमेट क्लेम्स ये होने वाले हैं। अब इसका जो आंसर दिया हुआ है, कैलकुलेट क्यूमुलेटिव डेवलपमेंट फैक्टर, सुनने में हैवी लग रहा होगा, बट सिंपली क्या है, ये जो फिगर्स हमने कैलकुलेट, बहुत पहुंच पहुंच हो गया, ठीक है, 1 to 2 का लेट से हमने वो जो वेटेड एवरेज निकाला था दैट वाज 1.16, मैं गलत हो सकती हूँ, मेरे को एग्जैक्टली फिगर याद नहीं है। 2 to 3 का एक्सपीरियंस के लिए मैंने बोला था ओके 1.02 होता है। सो दिस इंडिविजुअली इज कॉल्ड अ डेवलपमेंट फैक्टर, डीएफ। 1 से 2 डेवलपमेंट फैक्टर इज 1.16, 2 to 3 डेवलपमेंट फैक्टर इज 1.02। तो अगर कोई 100 से स्टार्ट हो रहा है तो वो सबसे पहले 116 होगा, एंड देन 116 से वो 1.02 टाइम्स होगा, विच इज 118, ठीक है। सो दैट इज हाउ यू यूज द डेवलपमेंट फैक्टर। यहां से यहां जाने के लिए DF1, यहां से यहां जाने के लिए DF2। नाउ यहाँ पे एक वर्ड आया CDF, सिंपल मैथ्स, मैं सीधा 100 से 118 का फिगर भी बोल सकती हूँ यूजिंग अ मल्टीप्लायर ऑफ 1.16 to 1 times 1.02, which is 1.18 obviously. So this figure is a cumulative development factor कि 1 को उसके ultimate तक लेके जाना. For now we are assuming that 3 is the ultimate. अगर ये और ज्यादा होता तो मैं और सारे factors multiply कर देती कि if you start from 100, let's say अगर मुझे 10 ये था development period 1, I know development period 10 is the ultimate, तो मेरे पास 9 factors होते, एक 1 to 2 का, एक 2 to 3 का, similarly एक 9 to 10 का, 1.16, 1.12 times 1.01. तो ये सब मल्टीप्लाइड करके जो फिगर डेवलपमेंट फैक्टर बनता है उसको बोलते हैं हम क्यूमुलेटिव डेवलपमेंट फैक्टर. सो कैलकुलेट CDF, मल्टीप्लाई रिपोर्टेड क्लेम्स बाय CDF फॉर ईच पीरियड. हम अगर एक एक्सीडेंट ईयर की बात कर रहे हैं तो 100 times CDF विल गिव मी द अल्टीमेट सम ऑफ रिजल्ट्स फ्रॉम द अल्टीमेट. तो बेसिकली मुझे इस एक पर्टिकुलर एक्सीडेंट ईयर का पता है कि ये बनने वाला है 150. So that is the ultimate loss for 1 year. Similarly, 2017 के दो फैक्टर्स है मेरे पास, दो एक्सपीरियंस पॉइंट है 90 एंड लेट्स से 110. तो मैं इसका 2 to 3 से लेके 9 to 10 का एक CDF बनाऊंगी क्योंकि 2 पर आ गया है, मुझे इसको 2 से 3, 3 से 4, सिमिलरली 9 से 10 तक लेके जाना है. तो मैं 2 to 3 से 9 to 10 का एक सारे डेवलपमेंट फैक्टर्स मल्टीप्लाई करूंगी, एक CDF मिलेगा, इसका भी अल्टीमेट आ जाएगा मेरे पास. लेट्स से इसका अल्टीमेट हुआ 140. ऐसे मैं सारे सालों का निकाल के अगर सम कर लूंगी तो मेरे पास आ जाएगा अल्टीमेट लॉसेस. अंडरस्टूड? एकदम सिंपल लॉजिक से सोचना. ओके, इस पर्टिकुलर एक्सीडेंट ईयर का 2 एक्सपीरियंस हो गया, अब मुझे इसको 2 से अल्टीमेट तक लेके जाना है. तो एक डेवलपमेंट फैक्टर होगा 2 to 3, फिर 3 to 4, 4 to 5, ऐसे करते करते 10. इन सब का प्रोडक्ट कर दिया तो CDF बन गया. तो 2 को अल्टीमेट तक ले जाने के लिए 2 to 10 का CDF हो गया. सिमिलरली लेट्स से अगर कोई 5 पे है तो ओके इसका कम होगा, 5 to 6, 6 to 7, 7 to 8, सिमिलरली अप अंटिल 9 to 10. ये सारे डेवलपमेंट फैक्टर्स का एक प्रोडक्ट बना लेंगे तो उसका CDF बन गया. तो अभी तक जो पता है 3 के एंड पे जो पता है 3 to 10 का CDF हमारा अल्टीमेट आ गया. उसके लिए सारे साल का करेंगे ऐड तो हर एक्सीडेंट ईयर का दिस इज द अल्टीमेट. गॉट इट? Oh, I'm so sorry, Aarti. I thought everyone was comfortable in Hindi. Do you want me to repeat?
Yes, ma'am.
All right. From where?
From this part alone, it is.
All right. I'm so sorry. Let's talk about CDF one more time. Let's say we have 18, 19, 20. 1, 2, and 3. Whatever figure, 110 year, and let's say 110 year. Now using our development factors, Aarti, I want you to switch on your mic and just tell me if you don't understand any bit. All right.
Okay.
In the past, we've seen that we've calculated some development factors. Basically, the factors that we've over here, if you can see, we had calculated a development factor of 1.15.
Yes, ma'am.
That was from year 1 to year 2.
Okay.
So that was development factor for year 1 to 2 of 1.15. So 110 became 126.5.
Yes.
Now we have also calculated a development factor for year 2 to year 3. Let's say it was 1.10. So this will become 121 and 126.5 will become 1. What did we do? 1.1. So 139. All right.
Yes, ma'am.
So what we did when a claim had for an accident year, let's say 2020, we only had experience up until first development period. So 110. What we did was we multiplied it by development factor from year 1 to year 2. And then further we multiplied development factor from year 2 to year 3 to get to, okay, this is what the ultimate is going to be for that year? Yes or
ma'am.
no?
Yes.
110 became 126.5 using development factor 1 to 2. Similarly, 126.5 became 139 using development factor 2 to 3. Now, what is this CDF that they are talking about? CDF is nothing but the product of these two elements, development factor 1 to 2. And if I multiply these two, what I'll get is I'll directly go from 110 to 139, right?
Yes, ma'am.
So these two multiplied together is the CDF, the cumulative development factor. Similarly, if something, let's say, if a particular line has reaches its ultimate by year 10, and we are currently in year 2 for a particular accident year, all right?
Yes, ma'am.
So now what development factors will I multiply? I will multiply 2 to 3, 3 to 4, and so on up to 9 to 10. Does that make sense? Because we already know what the experience is at the end of second year. Now I have to take it from second to third, third to fourth, and so on.
Till 10.
What?
Till 10.
Right. So we'll multiply the development factors 2 to 3 times 3 to 4 and so on up until development factor 9 to 10. So that becomes the cumulative development factor.
Okay.
All right. Now multiply. Now this CDF will be different for each accident year because if let's say 2018, we are in the second development period right now. Then 2019 we'll just have one. Yes or no?
Yes, ma'am.
So then for the CDF for 2019 will include all of these plus a factor for development from period 1 to period 2. So the CDF for 2019 will be different, but we are going to use that figure to reach from year to the ultimate directly.
Okay.
All right. So calculate CDF, multiply reported claims by CDF for each period. You'll get to the ultimates of each, basically the 10th period value for each accident year. And then some result of the ultimate loss. If I add all of these, I know what the ultimate losses are going to be across all accident years combined. Got it?
Yes, ma'am.
Ma'am,
Yes.
ma'am, the amount 145 and 120.
145, 120, where?
Ma'am, where the claim has written.
Year?
No, ma'am. In the middle, the claims 145 and then 129 and 120.
Right. Yes.
Yes, ma'am. If we add all this, that it would be the ultimate loss.
Yes. This is what I was making here. The 10th period value, the 10th development values. I know at the end it's going to be 145, 129, 120. If I add all of these together, that is going to be the ultimate loss estimate.
तो मैम इतना ही हमें रिजर्व बनाना पड़ेगा ना?
नहीं, इसमें से कुछ जो हम ऑलरेडी पे कर चुके हैं तो वो हमारा रिजर्व नहीं होगा. इसीलिए जब हमने पिछले स्लाइड में देखा था कि रिजर्व मेरा 24 और 529 ही है, क्योंकि ये तो मैं दे चुकी हूँ ना. 145, 125, 130 अकाउंटेड है. क्या अकाउंटेड नहीं है? 130, 150 बन जाएगा. तो 20 अकाउंटेड नहीं है. 20 वी नॉट अकाउंटेड फॉर. So that 20, 125 will become 129. So what is not accounted? The additional 4. And again 150 will become 155. So 5 accounted nahi hai. So 29 is my IBNR. This is my ultimate loss, out of which I know things. मुझे जैसे ये ट्राइंगल में कुछ तो लेट्स से 110 पता है, तो 120 में से 100 पता है, तो IBNR is only not reported वाला part, which is 20. Understood? Everyone? All right. Next question, what is a catastrophe model and why is it used in general insurance? I'll give you a very simple example. Right now, so far, I have only discussed majorly health examples and motor examples with you, right? Why did I not discuss property so far? Because in property claims, properties are subject to catastrophe claims. What does that mean? They are prone to claims that can arise from floods. Floods are still frequent, but they are also subject to catastrophic events like earthquake. Now, for earthquake, I do not have enough past data to say, okay, there's a chance that there's going to be 10% claims and the severity given an earthquake is going to be this much. So I think this is the risk premium that I should charge. So catastrophic events are rare, and that is why we can't rely on, let's say, data set of 5 years or 10 years to gauge the impact of what the risk premium is. Over here comes into the picture catastrophe models. There are various companies that have models, lot of data, lot of research that tell us, okay, this pin code, depending on data of 100 to 100 years, this is what the expected frequency is. This is the severity given the property insured. So that is what a catastrophe model is. Companies don't rely on their own data because the claim events in the data set is sparse. Let's say uh, last 5 years there was no tsunami. All right, now if I uh, price your property basis this 5 years data, I'm not taking into account tsunami. All right, now that is why we use data from these catastrophe models that use data of 100 to 100 years. They also do their database is also based on the research of, okay, soil type, this is a fault, this can like this fault has a return period of, let's say, 100 years, so this is what the probability is going to look like. And they use all of that data to tell me what the risk is and how much premium we should charge. So models simulating large scale events, example, earthquake and floods. So extreme large scale events cannot be priced based on our data set. That is why we use catastrophe models. Next, what is it used in? Pricing. I've told you the example that I just gave you was for pricing. Next is risk management. Now that we've written a portfolio, we can use catastrophe models to gauge, okay, what the claims are going to be like. Are we prepared? Do we need to put aside more capital for the risk? So that is a part of risk management. Next is reinsurance planning. Okay, once we've written all this risk and we think, okay, no, this is too much. And that is where reinsurance comes into the picture. Okay, I will cede this much part of this risk using the data from catastrophe model. Understood?
So, ma'am, catastrophe model is not prepared by the insurance company
No,
themselves.
there are other companies like Air, RMS that have these models because they are data rich. It requires a lot of research basically upon what has happened, what is documented. Let's say 100 to 100 years of data, and my insurance company has only the data that my company, the claims that I have experienced. But for something of this scale, we would want to use the data across all insurance companies or across the globe, all what all information we have, we would want to use that data to price a particular risk. So we don't simply just rely on the data that we have. That is why we outsource this task to these catastrophe modelers. We use their
Okay, ma'am.
models. We give them our data set. Okay, this is what the risk is. You tell me. Or this is my portfolio. What do you think? What reinsurance should I buy?
Okay, ma'am.
Okay. Next is, what is the minimum solvency capital requirement as per IRDA regulations? The answer is simple, at least 1.5. Now, what does this mean? It is calculated as ASM by RSM. What is ASM? It is available by required. So the regulator tells us when you require 100, you have to at least have 150, at least. At least 150. So that would mean a solvency margin of 1.5. What you require goes in the denominator. If you require 100, you should at least have 150. So all companies need to have this solvency margin. All right, this is called the solvency ratio. Now, how do we calculate the have and the require? It is a set, uh, basically a set template by the regulator. You need to fill in your, for what is required, you need your claims data and your premium data. So it calculates, it has a lot of factors that are LOB wise. So using that data, it will tell us, okay, this is what you require. And for the have part, there are different assets that the company has. Then they've put in conditions. Okay, equity, you can only take this much. You cannot take into account furniture while you're calculating. Basically, they have admissibility conditions for your asset. Then you subtract your liabilities from it to get to, okay, what we have. So in simple, what you have should be at least 1.5 times of what you require. What you require and what you have are simple templates that you have to populate, and they'll give you the ASM RSM value. Understood? The figure
Yes.
that you need to remember is at least 1.5, 1.5 or higher. That is the regulatory minimum for a company to operate. Because, okay, why 1.5? Someone, if anyone can tell me why 1.5? Why, if we need 100, why are we keeping 150? Why would the insurer want, why would the regulator want that?
Because there can be more claims than what we have estimated.
Right.
So,
The regulator is interested in policyholder protection. So they want us to keep a margin of that 0.5. So if there's some adverse event that occurs, if we have not valued our liabilities correctly, for example, we need to keep that margin. Okay, if you think you need 100, you better keep 150 at least. So that even if there's some up and down, we have enough money to service the claims that arise from policyholders. All right. A very simple question. How would you approach pricing a new product for general insurance? You analyze customer needs and risk. Goes without saying, okay, I think pay as you drive, let's say, for an example, is a new product that people are asking for. So I will, okay, this is what they need. This is what my product structure is going to be like. Next, the R&D department, along with inputs from technical department, let's say the motor department in this case, from the actuarial department, will make a product. Okay, this is what a product should look like. Next, it will come to the actuarial department for the next 4 steps. What will we do? We will gather and clean data. We will use our past data. If the product, for now, we are assuming that we have experience of a similar product. Let's say if I'm trying and pricing a pay-as-you-drive policy, I will use the experience of my motor claims term data. I will gather and clean the data. I will use models to predict claim cost. Now, what is a model? One, for example, is frequency severity model that we just use. Okay, what do I think the frequency is going to be like? I will use the cleaned data to gauge that. Similarly, I'll calculate what the severity is going to be like. Multiply the two, I will get the claim cost. So there are different models such as burn cost, to predict what the claim cost is going to be. There are more statistical models and methods like GLM as well to predict the claims cost. Then, once we have the claim, remember we had discussed that once you get the premium, claims is just one part of it. Using the frequency severity, I can know what the claims are going to be like, but I will have to add for other elements as well. So for that, we are adding for expenses, both commission and management expenses. Okay, that will alone will take care of only my outflows, claim cost and expenses. But we will want to make some profits as well. So we'll add for profit margin. And let's say, what is the risk load? I think what I have calculated here needs a little bit of margin as well. I think the data is telling me the claims are going to be of 100, but I think I'll need another 5 rupees margin. So I can add for that margin as well. And then the last step would be to validate and refine the model. How can we validate? You can take inputs from technical department because they're working in for that product, for that insured only. So they have better idea of what the risk premium should be like. You can take inputs from them. You can see if any competitor has launched this product, what are their rates. Our rates should not exactly be the same, but should be close. Let's say if my competitor is charging 100 rupees for something, I can't just go out and charge 250 for it. It could either be 85, 90, 120, 125. If my pricing methodology is giving me 250, I'll have to check if there's something that I've done wrong. So I will validate and I will refine the model as required. So step number one is understanding the need. Step number two is collecting and cleaning the data required. Three would be to use models to predict the claim amount. Claim alone, claim amount alone won't be sufficient. So we add for expenses, profit margin, risk load. And then once we have all right, okay, this part here is called the pure premium. And when we load for everything else, it's called the office premium. This is what we're eventually going to charge. So then we validate and check, okay, this is what our office premium is, what it should be, and we validate and refine the model accordingly. Got it? Okay. Next, how would you assess the profitability of an insurance product? First, we could look at the combined ratio. We've discussed this. Or we can just look at the loss ratio as well. Third is I've written down investment income. Why is investment income coming into the picture? Anyone?
Ma'am, because the premiums we have collected, we had invested somewhere else, so the
Right.
interest we are getting.
Yes. Everyone else understood? All right. I'll just give you a simple example. I've collected 100 rupees and the combined ratio is 102. So for every 100 rupees that I've collected, I'm paying out 102 in totality for claims, expenses, and commission. So I'm making a loss. Maybe not, because when I got that 100, I have invested it, and that 100 has become 105. So now, instead of against 100, outflow of 102, the situation is for 105, the outflow is 102. So we have to take into account the investment income. We can take into account the investment income also if the investment income is substantial. If it's negligible, let's say 100 just became 101 or 100.5, then there's no point of considering investment income. But if the investment income that you've earned is substantial, you'll have to compare premium plus investment income. And on the other hand, you'll have losses, commission, and expenses. So to see if a product is profitable or not, we'll also take into account investment income. Understood, everyone? I think this was the last question for today. Yes. Next is compare actual performance with expected benchmarks. So what does that mean? Let's say right now I've priced a product, pay as you drive, for example. I've priced it at a loss ratio of 75%. Now, when I'm analyzing, I'm seeing, okay, the loss ratio is 78%. Now, if I don't compare it with the 75, what will I think? Okay, the product is profitable because the combined ratio 78 plus 10 is less than 100. So, okay, it's profitable. But no, I'll also have to compare that 78% with what I have assumed at the time of pricing so that I know if it is generating enough returns. I had expected it to perform at 75. It is performing at 78. It is bringing more losses to me than I had anticipated. So, how would you assess the profitability of an insurance product? We could look at the combined ratio. We could look at the loss ratio. We can also add an element of investment income. Also, we can compare the actual performance with the expected benchmarks. All right.
Yes, ma'am.
Anyone? Anything? Any doubts? or we can end today's session. All right then. See you in the coming weekends.